Of JPMorgan, they are breaking even on the year, far outpacing the broader group. But our next guest says the good times may not last. Let's go off the charts with Chris Verrone of Strategas, a Baird company. Chris, what are you looking at?
Hey, Melissa. Yeah, well, I think the big question that we're dealing with is, can you have a directional bull market in stocks when the banks are just simply not on the playing field here at all? And, we keep hearing that, well, the deposits will go to the big banks will be all right. But the big bank charts aren't particularly good. And if you look at the broader sector, asset managers are weak, investment banks are weak, brokers are weak. So I think this is getting, in some respects, worse, not better. Let's start with the biggest one, JPMorgan. And the question we have is it naive to think that JPMorgan can get through this entire crisis unscathed? It's been bouncing between this 130 to 140 level for the better part of the last month or two. It's flat on the year, I think up 1%. I'm a little bit reminded in 2008, if you remember, JPMorgan was the last bank chart to break. It actually was up on the year through about October, and it went last. So they tend to get to the best ones last. I think it's naive to think that JPMorgan gets through this unscathed when all of its friends, as Dan and Guy say, and I agree, are on or near their 52-week lows. Let's go look at Bank of America, sitting right on this 27 level. It actually made new relative price lows versus the S&P today, so there's been no relative improvement there. This 26-27 zone is major support. I do not think we want to see what happens underneath that. You go to some of the brokers, Morgan Stanley and Goldman Sachs are right on their lows here as well. Goldman down something like 8-9% this year. So I think the picture is more than just regional banks weak. And when I see Goldman soft, when I see Bank of America soft, and then lastly here, I'll show you BlackRock in the asset management space. And the reason we pay so much attention to BlackRock, of every stock in the S&P 500, it has the highest correlation to the S&P itself. BlackRock should look like the index. It is the index. It's a top 3 holder in 99% of U.S. listed names. It should look like the index. It doesn't here. Right back on the lows here. So I think there's something else going on. We did some work today looking at the last 100 years, right? We are 7 months off the October S&P low. Banks right now are down 20 over that 7-month stretch. It's the first time in 100 years being 7 months off the low where the bank stocks are actually down. So I think you got to be careful here.
Chris, Bonawyn here. Thanks so much for your work. Always appreciate it. A quick question. Do you think that there's anywhere within the financial services complex where one can find relative safety or outperformance, or would you just avoid that sector altogether?
I mean, I think that's a hard question. Something that we always preach in our work is you want to have the wind at your back. You want to be swimming downstream. I just think it's too hard to pick the 1 or 2 or 3 names in the sector that might work here. I mean, I guess you could say stuff like insurance brokers are generally one of the better parts of the group, but even just insurance at large is deteriorating here. Look at some of these life insurers. I mean, Met has broken, Prudential has weakened here as well. So, what I think is framed as an issue with just community or regional banks, I think misses the point that the entire sector seems infected with whatever disease is out there.
So, Chris, I mean, going back to that BlackRock S&P chart, is it safe to assume that it looks like the S&P will go lower then?
That would be our bet. I don't know if it's from here or if it's from a higher level, but I'm not convinced that we're through all of the drama here. I don't know if we have to go back to the October lows. What was that, 3490, 3500? But there does seem to be stress under the surface. I just don't think the index is telling the whole story here. You have S&P, roughly at the year-to-date highs. You have NASDAQ roughly at the year-to-date highs. The number of stocks making new highs is abysmal, right? So under the surface, this is a very different market than I think the indexes lead on.